The latest impact of the Federal Reserve meeting is to sell US dollar rallies higher, medium term, to sell gold and silver rallies higher, short term, to look carefully at stocks in this summer seasonal period of weakness. So in the near term, expect rallies to be sold. And here's why. If we look at the Federal Reserve dot plot, just go along here and you can see this dot plot. And just remember, as I've explained previously, this is the median interest rate expectations of all these dots here. So the median, if you line them all up in a row, the median is the value that falls in the middle of that line. And that's put into a nice table formula here, so you don't have to try to work out all those dots. It's much simpler to look at the table. Now, this is for September. Now, when you're looking at this, you have to understand what the prints are in relation to what was expected. So I've just put that in for us here, and I'll explain how I've reached those conclusions at the start of this video. If you look at the interest rate for 2025, you can see that analysts were expecting to be at 3.8. So in other words, they're only expecting 2 cuts. But look, the Fed said, no, we see 3 cuts coming, right, before the end of this year. Now that was why the dollar initially sold off, and that's why stocks initially went higher, because everyone said, hooray, interest rate cuts are coming and it's 3 before Christmas. Poof. Sell the dollar, buy stocks. But then look at the other detail. 2026, basically, as analysts were expecting, 2027 as analysts were expecting, the analysts' expectations are in the red here, right? And this line here is for the September meeting, and the one underneath was for June. So in other words, analysts were predicting this. This was what the Fed gave. So exactly as expected, apart from this front reading. But now look at the GDP. Okay, so GDP, analyst expectations on the top, slightly lower in the near term, lower they were expecting in 2026 and 2027. But look, the Fed said, no, we expect better growth than that for the US. 1.6 versus 1.4 expected, 1.8 versus 1.6, as you get the picture, right? So growth is expected to be firmer. Unemployment, look what the Fed are communicating here. The market's seeing a little bit more weakness in the labour market, and the Fed said no. You've got to bear in mind the context. We had that weak NFP print. We've had a big spike in initial jobless claims. Markets were thinking, oh, the weakening of the US labour market is here. And the Fed are communicating through this, but it's not falling off a cliff. So growth is a bit better than they were expecting. Unemployment is not as bad as economists are projecting in the Fed's view. And then look at the inflation. Now, this is where the focus has been. Now, the expectations for the core reading were 3.1, 2.6, 2.3, 2.2. Now, that's come pretty much in line, but lower than economists were projecting for the core reading. And if you look at the PCE, but you can see it's slightly higher for the headline than analysts were expecting for 2026. Now, what folks have said, they've looked at this and said, well, hang on, this is above the Fed's 2% target, right? So isn't the Federal Reserve meant to have a inflation target of 2%? So well, why are they sort of beginning to signal a sequence of interest rate cuts coming? And some analysts are saying, 3% is the new 2%. In other words, the Fed is signaling that they want to prioritize bringing down the cost of US borrowing at the expense of slightly higher inflation. That's what they're communicating. Right now, medium term, that's a little bit of a more risky outlook. And that's why, medium term, we've seen the move in the bond market, which is what got analysts kind of ears twitching. US 10-year yields, you see how they're pushing up. So in other words, and when you look at the short-term interest rate market expectations, look, you see higher for longer is now expected. So markets are saying, well, actually, if the Fed's going to pursue this, they're going to have to keep interest rates slightly higher for longer. And if they're going to allow inflation to bubble along, the risk is it spikes up. And of course, we've got all those tariff issues. Is tariff-induced inflation going to suddenly materialize? Is it going to become a specter that the market can't deal with? So that's the bottom line. So what that means, if we start going through markets, right, it means the dollar's just picked up a little bit, But broadly speaking, the Fed is still going to be cutting interest rates. So that's why sell the rallies. Buying the euro dollar dip makes a lot of sense. The ECB have signaled that they're pretty much finished cutting interest rates, right? Whereas the Fed's about to begin to cut interest rates. If you look at the yield spread between the German Bund and the US 10-year yield here, you can see that this is a dip worth buying. I'm buying in from 1,700. If I can get down to there, maybe even 1,720, I'll have a look at it as we drift down there. That's a dip to buy. Why? Because the yield spread is still pushing higher, there's still this divergence, and there's still fundamental reasons for dollar weakness medium term. So, sell the dollar rally. And remember, the euro dollar is just the anti-dollar index. When the dollar index goes up, the euro dollar goes down. So, buy the dip, sell the rally. That's the expectation there. For commodities, right? Now, this is I'll explain about gold in a bit more detail, but in the near term, we're seeing this dip on the stronger dollar and higher yields. Stronger dollar, higher yields makes commodities less attractive. So sell the near-term rally. Looking at stocks, just notice the S&P 500 has a very weak seasonal period that we're coming into, and if interest rates are going to be higher for longer, it means that business conditions are less advantageous for stock markets, and stock markets generally don't like the prospect of higher interest rates for longer. It means debt repayments are slightly higher, business conditions are stricter, and that's typically negative for stocks. Now, also look at this sharp move lower we get around this period of time. You can see, for 25 years, 15 years, there's a sharp period of weakness into a Q4 rally that tends to happen. So, in the near term, I'm sort of neutral-ish on stocks. I want to see where the order flow is. I'll be looking at the futures market to try and look at the order flow day to day for intraday trading. But my instinct says, okay, this is going to be dropping lower, right? Higher interest rates, disappointment that the Fed isn't going to be cutting interest rates aggressively, disappointment that inflation is still seen over 2% throughout the length pretty much of the dot plot, except for the very tail end of it. So that's that. Also, look at gold. Now, this is important here. Right, gold in the near term, you're expecting a bit down. It's had some tremendous rallies. Was speaking to clients about buying this breakout ahead of the Federal Reserve meeting, just this breakout here, and then obviously taking profit before the Fed. I took profit on my euro dollar longs and my silver longs before the meeting began, a couple of days actually before the meeting began. And now what to look for, right, in gold, keep your eyes on this chart. Now, what's this chart? This is Treasury and insurance protected securities and the dollar overlaid with gold. Now, TIPS, Treasury inflation protected securities, they're just US government bonds that rise in value when inflation rises. And what they're designed to do is to protect your money from inflation, okay? Because both the bond's value and the interest you earn adjust upwards as prices go up. So inflation, right, is hedged by having a Treasury and inflation protected security. And here's the key part. Gold and TIPS often move in opposite directions to each other because of this. Gold doesn't pay any interest. People buy gold mainly as a hedge against inflation. But TIPS, they do pay interest and they're inflation protected. So when TIPS are offering a good return, what traders call higher real yields, investors don't need gold as much, right? So they tend to push gold prices lower, and you see the inverse move in TIPS. On the other hand, when TIPS are paying very little or even negative return, gold looks a lot more attractive, right? That's when you usually see gold rally. So the very simple rule of thumb is when TIPS yields go up, gold goes down. When TIPS yields go down, gold goes up. Now I've got here the iShares TIPS Bond ETF, and you can just see here, this is inversely correlated on the chart to make it easy, because you have to be careful because the price of the bond and the yield move inversely to each other anyway. So you have to have a strong cup of coffee, sit yourself down and work it out. But once you've got it set up, it's easy. And essentially, when I've got when I've got the dollar and the TIPS moving down, gold goes up. You see here, right? When you've got the TIPS and the dollar going down, gold goes up, right? When you've got the dollar and TIPS going up, you've got gold going down. It's a very, very sort of strong correlation. It did break down with a lot of heavy gold buying recently, And you can see very unusually, you've got tips rising, yields rising, and gold rising this year. There's just the demand for gold was just unprecedented. And now it's sort of much more normal relationship. But you see this little ship higher in tips. So keep an eye on tips, okay? And if these start dropping down again, that's the time to buy into the gold dip. Otherwise, just wait. So for me, like this is a big round number around the 3,400. That looks attractive. I'm not interested in buying gold up in these markets with this latest change from the Federal Reserve. So folks, there's a little summary of what to take from the Federal Reserve meeting. If you got any questions or would like any help or would like someone to help you go through the day-to-day movements of currency markets and commodity markets and stock markets, don't forget to reach out and I can let you know how I can help you.